report. He's live from our Melbourne studio. Chris, great to have you with us. Seeing these positive moves there, and we're talking largely about that support coming from the mining sector, but it's fair to say we've been in this, well, holding in this fairly tight range on the broader index for the past month or so. What are you making of sentiment more broadly right now on the Aussie share market?
Good afternoon, Leanne and team. Look, I would agree with some of the sentiments on the panel that I think broadly it is positive, but yeah, when you do zoom out, obviously, and look at the chart over the past month, we have been caught in about a 100-point range between 62 and 63. Not surprising that we've stalled here for a couple of reasons. It's around a previous swing high, and as well as that, you know, we are coming into reporting season, and everyone, I think, is probably keeping their powder dry to some extent, waiting to see how all the numbers drop. Just on that reporting season theme, I think, and again, it's already been touched on, I think commodities-linked plays will do particularly well, and that's because we've seen commodities prices rising across the board over the past 12 months. Where I'd be a little bit concerned is companies that have significant input costs, which have obviously also risen on the back of rising commodities, but don't have, say, US exposure, so they can't get the benefit, the translation benefit of a weaker Aussie dollar. So it's locally locked companies that as I said, that have rising input costs that I'd sort of be on the lookout for this reporting season.
Sure. Let's talk BHP firstly, and we'll get into some of these reports there today, because obviously it came out yesterday with some very solid numbers. It was a good rise. I think in the end there it was up about 3% or so, and just seeing BHP, just having a look, it's up again today, $33.80, 0.7%. What was your view on the stock? Because I want to get Martin's thoughts in just a moment. I know they've upgraded the outlook for BHP. What was your view on it, particularly with respect to, I guess, their exposure not only to the oil price, but of course iron ore and various other commodities?
Certainly. So I'll start with the oil price. I've, again, been on record quite a number of times saying that I'm an oil bull. I know it has pulled back recently. I view that as an opportunity to be a buyer. And again, I reiterate that probably sometime later this year we see an 8 handle in front of WTI. So I like that story. Just reading, you know, through the results from yesterday, it seemed like they pressed very hard on the accelerator to up their iron ore production, which is not necessarily a clip they're going to be able to maintain, and possibly won't want to maintain anyway, because all of the big iron ore players don't want to flood the market and, of course, lessen the price for all of them. But look, overall, we like BHP. We are in the stock at the moment. We have it as an open trade. Price target is about $36. Hasn't moved for us, though, in terms of, you know, we haven't extended that price target off the back of the production numbers.
Martin, your view, because I know that you have upgraded your view on BHP. Price target now $40, so
yeah,
a fair bit of upside.
So, look, if you've been following Peter O'Connor, I know a lot of people that watch this show, you know, follow Peter O'Connor. He's called BHP pretty well. He's had a $34 price target on it for a while with an aspirational target of 40. So he said, you know, I think this thing can get to 40. So he used the production result as a catalyst to really upgrade that price target to basically 1.2 times NPV. So the argument is, as you get commodity tailwinds, and we've seen it with South 32 and we've seen it with Whitehaven, you can get stocks trading at multiples of what he thinks the long-term NPV is. So we've moved Rio to that a while ago, and we've now moved BHP to that now. So we do think at this point of the cycle, investors are looking for inflation hedges, and they'll chase things like BHP, and they'll start to pay a bit more of a premium. We have seen weakness in copper. Oil price has been bouncing around, so we do think there's a bit of a re-acceleration of those two commodities ahead of us. Data out of China looks quite good, so we do think that BHP, mostly on capital management issues as well, Leanne, because they're going to sell those shale assets and pay a big special dividend or a buyback. That could be the sentiment that pushes up to that $40 level. Well,
I think capital management will be a big focus, obviously, as we head into those earnings in August. When we consider, obviously, how much they are pumping, you know, out there, still so much iron ore supply going into the market. Still positive upside, do you think, for some of these big players, Rudy?
I've been saying for a while, you buy them for the balance sheet. So you buy them for the cash that comes their way, and you buy them for the fact that they're selling their shell assets, and they are going to give it back to shareholders.
All right, excellent. Let's get back to you, Chris, and we'll talk Santos while we are talking oil exposure. Obviously, fully exposed to oil there. We know, I guess, much like what we saw from Oil Search a little earlier this week, it was always going to be a fairly tough quarter given the earthquake that happened in Papua New Guinea. We have seen a reduction in their annual production, down about 5% compared to last year. But if we look at those shares today, actually up about 1.5%. It seems like they're moving quite well to shore up their balance sheet, maybe even restarting dividends. What did you make of the update from Santos today?
Certainly like the update, Leanne. Yeah, as you say, paying down debt, and that's been an ongoing story. Paid it down by another 4%, potentially reinstating dividends in August. I think that means that they will. Probably won't be a huge dividend, but it might attract a different type of investor back to the register. But again, I think the read-through with these results shows just how tied Santos is to the oil price, which is not surprising. We all know it. But again, me being on the side of thinking that oil prices will go higher, we like Santos. We have it in a long-term portfolio. I think the other thing that's important here is, we must all remember that they did knock back that bid from Harbour. They said, no, we're going to stand on our own 2 feet, and they're pivoting back towards, sort of a growth track. They're very interested in some gas fields in Papua New Guinea that they're looking at investing in. So, yeah, look, they're betting on themselves, and I liked that move at the time. I thought it was bold from the board, and I certainly thought it was ambitious, but as I said, I did like it, and it seems now that they're starting to follow through on that as well. So hopefully that will lead to further upside in the share price.
Well, certainly seen that upside today, 1.5%, $6.05 right now for Santos. Another good share price performance today is coming out of CIMIC, the top performer actually on the 200, 13.7% higher. Of course, CIMIC coming out after the market closed yesterday with their result, a rise in their revenues, cashback profit in the first half of 2018. So it looks like a pretty solid performance. What did the company attribute most of that performance to, and what did you make of the update?
Sorry, Leanne, was that for me?
That was to you, Chris, yes.
Yeah, sorry. Look, I won't go through the numbers again because obviously people have already been on the show this morning talking about it. But I think what they've done with restructuring the business, removing some of the complexities that have previously weighed down divisions, and their ability to continue to book revenue. So in the last 6 months, they've booked more than $7 billion worth of new projects. So it's just become a very well-run, efficient company that continues to attract new projects, which of course all these mining services and infrastructure companies need to do to, obviously further their books and boost their share price. So it just seems that they've got their house in order, and right now, off the back of the numbers, they're enjoying a fantastic share price performance today.
Look, when we consider what's obviously going on, I mean, some saying, things are looking fairly expensive. It's always so important to kind of delve beneath the surface to look for those opportunities. Where else? What else are you liking across the market at the moment?
Just on that lead in there, Leanne, I'll talk a little bit about QBE. It might ruffle some feathers from the other guys on the panel. It is probably one of the most hated stocks, and up until very recently, I would say that I probably hated it too. But there's just a shopping list of things, of positive elements that go into this one at the moment. So you'll forgive me, I need to refer to my cheat sheet. They're one of the cheapest insurance companies globally, and they are that because they have had some problems, but they're starting to right those problems. They've obviously sold off the Latin American division. And again, this is a company that's had to tidy up its ship operationally. I believe they're doing that. There's a tailwind in the form of, the rising US dollar. Which will lift the translation, of course, of their US dollar earnings, and rising yields as well. So it ensures that their deposits held to cover, obviously, liabilities. They'll get a better return from that as well. So like I said, there's just a few things lining up. The stock is pretty cheap. I know it's had its problems, but, all these things turn eventually, and I think now is the time where it's worth taking a closer look at QBE.
All right, excellent. Chris, I think we'll leave it there. We do need to get to a break, but thank you so much for joining us. We really appreciate your time today. Thank you.
Thanks. Cheers, guys.
That was Chris Conway there from the Australian Stock Report.